Good evening. My name is Socrates Xanthus. I am the professor for commercial real estate finance at the University of Central Florida. In this exercise or this video, I'm going to walk you through the second half of a pretty complicated pro forma. And so wanted to record a quick video to show you how to get through the before tax cash flow, beyond the before tax cash flow row that you're going to start with. But before I do that, I want to kind of do a quick recap what we covered in class. When we were given this exercise, we started with the rent roll. So we calculated the base rent for all of the tenants in this building. We calculated the annual adjustments for those that needed annual adjustments. We did we created the expense table, calculating the total expense for this property. We also begin the annual cash flow, which we needed to do that in order to come up with the price for the property. Since we were not given the price, so we had to calculate the NOI in order to use the cap rate for unlevered year one return to get the purchase price of the property. So we calculated the purchase price here. We also calculated the purchase information here. And then we, of course, completed the loan information here as well. So if you've done all of these steps and you stopped at the before tax cash flow row here, which is step 19, we can go further and complete the remaining steps for this problem. Again, because this is a very lengthy exercise, I have some hints here. All of the items you see in yellow on the right next to the rows or the tables are the steps that I've indicated that you would follow in order to complete this exercise. So from this before tax cash flow row, if you end it here, you would need to go scroll down to your tax value table to calculate the annual depreciation. So step 20 is the next step. You have to calculate the total annual basis for this property. To calculate that, you simply need to add the purchase price and the acquisition cost. And I'm referencing here cells B2 and B3, which are the purchase price and the acquisition cost. This would give you the total basis for this property, and that would be $5.5 million. And we were told that land is worth 25% of the property, and the improvements, which is going to be, was at 75%. What we're going to calculate here is what percent, 25%. Land, how much is that? So what is 25% of 5.5 million? You would use this formula here, equal to 25% times the actual total basis. And if you anchor that, you can drag it down and get the value for the land. This is important because you cannot depreciate land. You can only depreciate improvements. So we're going to need to calculate the actual improvements, which actually happens to be again, 75% of the 5.5 million gives you 4.1 million. Once we do that, to calculate the annual depreciation, since we cannot depreciate land, the annual depreciation then is going to be the 4.1 million divided by 39. Since this is a commercial property, not a residential property, it will be depreciated over the life of 39 years. This is very important that you understand that. And then we were also given the CapEx recoverable life, which is 7 years, and that's important, will be important later on. Once you complete the tax value table here, you can scroll over to the left and complete the actual depreciation schedule here. This piece here. In order to do that, you need to complete this part of your table, the period, months, the real property amount, depreciation for each year, the cumulative total, the CapEx, and then the cumulative CapEx depreciation. Since we're holding the property for 5 years, you'll have 1 through 5 for your years. And we were told that we purchased the property in January of the first year, and we're using the mid-month calculations. And in order to do that, you will need to do the following. You would need to know that you're holding the property for 11 and a half months. Since you purchased it in January, we're using the mid-month calculation for the first year. You're holding the property for 11 and a half months. Of course, you're going to hold the property for 12 months for year 2, years 3, and years 4. And we were told that we're selling the property in December of year 5. that would mean you'll be holding the property for 11 and a half months for that year as well. This is going to be important for you to calculate the prorated amount for the depreciation for each year. For the first year, this is going to be a formula that we're going to use, and you'll use the same formula for the rest of the years. It's going to be the number of months that the property was held for. In our case, 11 and a half months divided by 12, which will prorate it for you for that year. And you will multiply it by the annual depreciation, which is the $106,000. If you anchor that on only that, you can drag it across. It will calculate the depreciation for you for the subsequent years, ending in year five. Year five, since you're holding the property for 11 and a half months, it should equal what you have in year one, since the holding months are equal. But for years 2 through 4, it should be the full depreciation of $106,000. In order to calculate the cumulative depreciation, you're going to start with year one. It's going to equal the year of the cell above, since that's the first year. However, for year 2 through 5, you're going to add the previous year depreciation cumulative plus the current year depreciation. So it's going to be, for me, B80 plus C79. And you don't have to anchor any of those, but you will need to, it will allow you to drag it across, ending in year 5, where you're seeing that you're using the same formula of the previous year cumulative depreciation plus the current year depreciation, totaling $524,000. To calculate the CapEx depreciation, we're going to go ahead and divide the CapEx that was referenced. We're going to reference the CapEx that was taken above at reserve, rather, 17,000. And as I mentioned before, the CapEx recoverable life was 7 years. So you're going to divide that. You're going to use this formula, equal negative the CapEx above, so you can make that number a positive number, divided by 7 years, which is, again, the recoverable life for the CapEx. If you anchor that and only that, and you will be able to drag it across and get the CapEx depreciation for all the years ending in year 5. The same formula that we use to calculate the cumulative depreciation above here, we're going to use the same formula down here. The first year is going to be the cell above, which is the CapEx. Year 2 cumulative CapEx will be the previous year cumulative CapEx plus the current year CapEx, which will, and we do not have to anchor any of these two cells, and we could drag it across, which would give us the $13,695 in year 5. That would be how you complete step 24. To complete step 25, you're going to shift to above, and provided that you completed the table for the levered annual tax calculations, we should be able to calculate all of these numbers here. And let's go ahead and start. For the NOI, this is already, should have been calculated already. Just going to reference your NOI row above. NOI equal this cell here. You don't have to anchor it, and you can drag it across. It will give you the NOI for all of the years. For the CapEx, we already have the CapEx up here somewhere. CapEx was up here. Let me see. We're going to go ahead and we're going to reference the CapEx up here, which for me was C31. The only difference is that we're going to change that number to a positive number. So since CapEx was negative, we're going to say equal negative that CapEx to make that number positive, and you don't have to anchor it. You can drag it across to get the CapEx, bring that down here for years 2 through 5. This is the next row is going to be the mortgage interest. What we're doing here is we're trying to reduce our taxable income by, the government allows us to get credit for the mortgage interest payment that we've made, as well as the depreciation recovery, as well as the CapEx appreciation and the amortized loan cost. But for the mortgage interest, Excel has a very cool function called the cum I payment. It's very similar to cum principal payment. This is going to it's going to give you the hence here. The formula is going to be equal cum I payment. You're going to see the hence down here. It's going to equal the rate. So it's going to start with rate, which is 4.5, I believe, 4.55%, divided by 12, because 12 months in a year. The number of period, which is 25 times 12 to get the month. And then the present value is the debt amount, referencing B5, which is the debt. And then you have the start period. Okay, this one's interesting, so I have to follow this instruction here. You don't anchor these, but it's important to see that we're saying the start period is B21 times 12 plus 1. What does that mean? B21 happens to be 0. The start period is simply just 1, but 0 times 12 is 0 plus 1 is 1. The reason we do that is so that when we drag it across, it would do it automatically for the subsequent years. So the start period is simply 1. So all of this, B21 times 12 plus 1 is simply 1, comma, C21, which is basically for that year, C21 is 1 times 12 is 12. So it's 12 months in a year. And then the end period is 0. If you set up your function this way, you can drag it across. It will give you the cumulative I payment for all the years ending in year 5. And the depreciation recovery, we've done this already. We're just going to reference the cell down here. If you recall, we did the depreciation recovery for year 1 through 5. The only difference is that since this is getting us credit, or we need to deduct it, we're going to make that number a negative by simply adding a negative sign in front of it. So equal negative the depreciation for that property. You should have 102,000 for year 1, and then if you drag it across, you have the 102,000 for year 5, as you can see here. Same thing here we did for the depreciation of the property. We're going to depreciate the capex as well. We did it already. The capex recovery or depreciation was $2,465. We just took that number here and made it a negative number, equal negative. That will change the sign to a negative number, and we will be able to drag it across and get the 3,027 for year 5, as we did down here, since it's pulling it from down here. Now, if we once we are done with the depreciation recovery and the capex depreciation, we have to do the amortized loan cost recovery. This is important that you need to understand that part. The loan cost was $49,000. Remember, the term was for 7 years. Although we held the property for 5 years, we have to divide the loan cost by 7. So what we do is we're going to say equal negative the loan cost, which is 49,000, dividing it by 7, which is the term. And we're going to anchor both of them, because the number is going to be the same for every year thereafter. Remember, we're just dividing the loan cost by the term. That's what we're doing. And we're going to drag it across. We're going to have that. So every year we're going to depreciate or get credit rather for the total loan cost that we paid. It's going to reduce our taxable income by that amount every year. Now, once you're done with that, you should be able to calculate the taxable income. The taxable income will simply be the sum of the NOI, the capex, and the mortgage interest, the depreciation recovery, the capex depreciation, and amortized loan cost. If you do that, you can drag it across and have end of year 5 with $222,000. Now that we've done the taxable income, we now know what we can be taxed on. If we can be taxed on $118,000, we need to now calculate the tax liability. The tax liability will be using the ordinary tax rate, which is 39%. So the tax liability then would be the taxable income times the tax liability. If you anchor the taxable rate, you're going to be able to drag it across and get the tax liability for years 2 through 5, ending in $86,699. One of the steps that I've mentioned that you should do also, just for later on, is to calculate the total amount for your capex by just summing. You sum the row of capex from year 1 through 5. You sum that, and you should have a total capex for the 5 years of 95,000. And then you also will do the same thing here for the amortized loan costs. Again, although the property, the term was 7 years, we held it for 5 years. So the total amortized loan cost really wasn't 49,000. It was really $35,000. So these two numbers are cells. We're going to reference them later on in the problem. Now that we've completed the step 25, A, B, and C, we're going to go ahead and complete step 25D. The only difference between levered annual tax calculation and the unlevered annual tax calculation is going to be the mortgage interest and the amortized loan costs. I'm going to highlight those in yellow so you can see, because the unlevered annual tax calculation will look very much like the levered annual tax calculation, with the exception of these two things that I just highlighted in orange. So therefore, we're going to bring down for the NOI, bring down the NOI from the levered. And then if you do that, you don't have to anchor it. You can just drag it across to get your same NOI for unlevered annual tax calculation. The CapEx, we're going to bring that down as well from up here. Same thing we did here. We're going to just go equal that and just going to drag it across, and we'll have the same number here. And then the annual depreciation, the CapEx depreciation, we're just going to do the same thing. We already did the work. Going to just drag it across and bring it down. The depreciation recovery, same thing we did here. We're going to bring that down. We've already done all the work. Just going to drag it and bring it across here. Let me go back here. Sorry. Going to bring that across here. And then now we're going to calculate the taxable income for the unlevered tax calculation. Same formula. We're going to sum the NOI plus the and the CapEx depreciation and the depreciation recovery, and you're going to get 264,000, and you're going to drag it across to end the year 5 with 354,000 for year 5. And then therefore the tax liability for the unlevered tax calculation is going to be 39% of the taxable income. And we're going to reference 39% is the ordinary tax up here. We're just going to simply multiply or equal taxable income times the ordinary tax rate and anchor your tax rate so you can drag it across, and you're going to end the year 5 with $138,000 for your tax liability for year 5. Now that you've completed step 25, we're going to go down to step 26. We can go then up here to bring up the step 26. I'm sorry. So we're going to bring up this the tax liability for the levered tax liability. All we're going to be doing here is referencing this cell here and bringing it up here. So it's going to be equal to negative the tax liability row here. Since it's a negative amount that's coming out of your pocket, you make that number a negative. So it's basically simply referencing the calculation that we just did a few minutes ago. So it's equal to this cell here, negative or equal negative that cell to make it a negative number. Do not anchor it, and you can drag it across to get the tax liability for years 1 through 5, which year 5 should be again negative $86,699. Now that you've completed the step 26, you can easily do step 26A. That's simply going to be the sum of the before tax cash flow and your tax liability. As you can see here, do not anchor anything. The formula will flow for you for years 2 through 5. You should end the year 5 with $145,000. I'm going to pause and tell you not to touch these row for now. This is going to be almost the last thing you're going to do. And so do not worry about this right now, because you can't really calculate year 5 until you get the net value or the reversion amount. So let's just not touch these four rows for now, because it's going to go down to step number 27. Step number 27 is going to be down here. We're going to do the levered sales proceeds before tax. If you can go ahead and complete this table here, this is going to be not too difficult. We're going to need to calculate the sales price at year 5. We're going to use the cap rate formula. Since we have the NOI for year 5, which is up here, we're simply going to divide the NOI, H49, divided by the exit cap rate, which is 6.45. If we do that, we should be able to get $7,098,000 for the sales price after 5 years. Once you do that, you can easily calculate the selling cost, which is going to be basically 5.75% of the selling price. And you will make that a negative number by putting an equal negative in front of it, since that's money that's going to be out of your pocket you have to pay at the time you're selling the property. And the debt retirement is a little tricky for a lot of people. This is the remaining balance, basically after 5 years. How much do you still owe the bank for this loan that you took? Remember, the loan started off at $3,089,000 and some change. You want to know how much you owe after 5 years. You're going to use the print formula. The formula is equal negative. The B5 is the debt amount, the $3,089,000 that you can see here. And you're going to subtract the minus cum print, which is, we're going to use the interest rate, which is C9 divide C9. I'll show it up here. C9, 4.55%. Divided by 12, and then next is going to say the number of payments, which is going to be the 25, I believe, 25, which is C10, 25 times 12, comma, the present value, referencing back to the debt amount, which is $3,089,000 and some change. The start period is 1, and then the end period is going to be, where it's basically it's 5 years. F18 is going to be 5, or F5, the holding period is 5 years. This is how many years we're holding it for, times 12, which will give you the end period, and then comma 0. That should give you the debt retirement. Once you get the debt retirement, you can simply sum the sales price, the selling cost, and debt retirement to get the sales proceeds before tax. This is how much money you're going to walk away with before tax. Now that we've done that, we can calculate the unlevered sales proceeds before tax. The only difference here is that here we had a loan, here we don't have a loan. So here the sales price is the same. We can just reference the sales price here, and then the selling cost, the cost to sell the property will remain the same. We're just gonna say equal to that selling cost we calculated over here. And therefore the sales proceeds before tax for unlevered is going to be the sum of the sales price and the selling cost, which is $6.6 million. Now that we've calculated the levered sales proceeds before tax and the unlevered sales proceeds before tax, we can go and calculate the gain on sale. The gain on sale, parts of it will be quite simple. Parts of it will be some things we have to explain. The gain on sale, you want to go ahead and create this template here. And you're going to go ahead and start with the sales price, which is already calculated above. The closing cost is what we've already calculated above as well, the selling cost. The adjusted basis, if you remember, the basis for the property was $5.5 million. The adjusted basis says that we have to add to it I apologize. The adjusted basis, you first put in the equal negative open paren the basis that we had, which is 5.5 million. Then you're going to add what I had up here, the CapEx amount that for the 5 years that we held the property for. That's the 95,000 that we calculated earlier. And then you're going to take out minus the cumulative depreciation for the property. That is the adjusted basis. So again, it's going to be the initial basis, the 5.5 million, right? You adding the total capex that we saved over the 5 years, which is 95,000, minus and deduct the cumulative depreciation over 5 years, which is this cell here, which should total 5.1 million. Once you do that, you can sum up the gain. Your total gain, once you've done that, is going to be the 7 million adding together, rather, the 7 million taking out the closing cost in the adjusted basis, which we're going to have a gain of $1.5 million. Therefore, the depreciation taken, we're going to put that back, is going to be the cumulative depreciation that we took, which is from the depreciation schedule here. And you're going to make that a negative, equal negative depreciation, negative cumulative depreciation, which is that $524,000, but you're just making that number a negative number. The taxable gain is going to be then the sum of the gain and the depreciation taken. If you've done that, your taxable gain will be $1.1 million. That's how much you're going to be taxed on. Then what the question is, what is your tax amount? Your taxable amount is going to be the taxable gain times your capital gains tax, which is 18%. So it's going to be equal to negative taxable gain times the taxable gains tax, capital gains tax, which is negative $188,000. Now that you've completed the gains table, you're going to go ahead and proceed to complete the the levered sales proceeds after tax table. Levered sales proceeds after tax. The levered sales proceeds after tax. You already have the sales proceeds before tax for levered, which is here. You're referencing that. So equal to the sales proceeds before tax for levered. And then now you're going to calculate the ordinary tax. This one is a little interesting, probably the toughest piece, but I'll explain as best we can. What you'll do here is, what you're trying to do before I show the formula is that you're going to get taxed on the difference between the total loan cost and the amortized let's see where the total amortized loan cost that you took. So for example, your loan cost was $49,000 and you got credit for $35,000. The difference is $14,000. You're going to be taxed on that, as well as you're going to be taxed also on the cumulative depreciation as well. So the formula is pretty lengthy, so I'll pause here for a second. You can pause the video to copy the formula. I apologize that I'm coughing. So the formula for the ordinary taxes equal negative, open paren, if, open paren, negative, for me, 864, which is simply the the total amortized loan cost for over the 5-year period. If that number is greater than 0, then you will use the loan cost, which is B4, which is 49,000. You're gonna add back the negative 35,000, which is going to give you really $14,000. And you're going to multiply all of that by the ordinary tax, which is 39%. And if not, it's 0, close paren, and you're going to add also the cumulative capex depreciation 13,695 time the ordinary tax as well. So you're basically adding these two things, and the tax amount for both the difference between the loan cost and the loan amortized loan cost taken, the difference there, the 39% of that plus 39% of the cumulative capex depreciation schedule. So that should be $10,829. The depreciation taken is going to be equal negative the total depreciation that was taken, which is $524,000, times the depreciation rate, and you're going to add that to the cumulative capex depreciation times its tax rate, which is 39%. So altogether, you're going to have $125,000 in depreciation tax. The capital gains tax is already calculated down here. So you're going to reference the capital gains tax here. It's going to be $188,000. Altogether, the levered sales proceeds after tax total is going to be the equal sum of the sales proceeds before tax, the ordinary tax, the depreciation tax, and the capital gains tax, which should give you $3.6 million. Once you're done with that, you're going to complete this table here, which is the unlevered sales proceeds after tax. So the sales proceeds before tax, we've calculated that already, which is $6.6 million. And your ordinary tax is going to be the cumulative capex for the 5 years, and that's going to be equal negative cumulative capex for the 5 years times the taxable the ordinary tax, which is the 39%. That should give you 5,341. And then the depreciation tax is going to be the, again, negative, equal negative, open paren, the cumulative depreciation for the property times your depreciation tax. You should have $131,000. The capital gains tax already calculated. You can just reference that cell here, C98. Once you've done that, your sales proceeds after tax is $6.3 million. Now, once you completed this table here, the unlevered sales proceeds after tax, you can calculate the return summary. But before you do that, you would need to go back up to the very top to calculate these 4 rows that I mentioned earlier. We would calculate last in order to do our return summary. To do that, we are almost done in wrapping up this assignment. For year 0, we're going to reference the initial investment for levered initial investment for this property is $2.5 million. We're going to make that number a negative number since it is a money out of our pocket. That is our initial investment. Our initial investment then for the unlevered sales proceeds, unlevered before tax cash flow is simply going to be the purchase price plus the acquisition cost. We're going to make that number a negative number as well, obviously. And if you have it for levered before tax cash flow and unlevered before tax cash flow, you can reference that as well for levered after tax cash flow and unlevered after tax cash flow by just equal to this, equal to that row here, that cell there. Once you've done the year 0, we can start with year 1. Year 1 is going to be the before tax cash flow levered. is already calculated. We've calculated already up here, which is the before tax cash flow. You're gonna reference equal the before tax cash flow row here, cell, and then you could drag it across, and you're gonna stop in year 4, because year 5 you're gonna be treated differently. These items are highlighted in orange because they're gonna be treated differently than years 1 through 4. So for year 1, for unlevered before tax cash flow, that's simply referencing the NOI, because there's no loan, so there's no debt that needs to be deducted from the NOI. You're going to simply put it equal to the NOI row or a cell, and then you're going to drag it across and stop at year 4. We're going to do the levered after tax cash flow is simply going to be the levered after tax cash flow. We're going to say equal to this cell, which is the levered after tax cash flow. We're going to drag it across to year 4, and the unlevered after tax cash flow is simply going to be the NOI, and you're going to have to deduct the tax liability that we calculated on the unlevered tax calculation. If you do that, that should give you, again, NOI minus the tax liability for unlevered tax calculation, which will give you $248,000. If you drag that across to year 4, you should have $288,000 for year 4. You should now have this table almost completed. In order to calculate the year 5 before tax cash flow, we're going to reference 2 things: the before tax cash flow and the net value that we calculated down here for levered sales proceeds before tax, which is C89. To do that, you now have, for year 5, for levered before tax cash flow, you should have $4.2 million and some change. For unlevered before tax cash flow for year 5, we're going to do a very similar referencing here. We're going to go with the NOI. We're going to add the NOI plus the unlevered sales proceeds before tax, which is G87. That should give you, we're going to, again, NOI plus the unlevered sales proceeds before tax, which will give you $6.6 million for that, but it should give you $7.1 million, I'm sorry, for the unlevered year 5 before tax cash flow. Now, to calculate the levered after tax cash flow for year 1, we're going to reference, again, we've already calculated the levered after tax cash flow up here, C53. We're going to drag it across to year 4. For year 5, we're going to reference or utilize the reversion amount in this formula as well. We're going to do the levered after tax cash flow plus we're going to add the levered sales proceeds after tax, which is G96, which will give us the amount we're going to walk away with for year 5. Now, for unlevered after tax cash flow, we're going to start the same way. It's going to be the NOI minus the tax liability, which is the $103,000 that we calculated in the unlevered annual tax calculation. If you do that, you should be able to drag it across for years 2 through 5. So therefore, for year 5, we're going to calculate that using, there's 3 things you got to add up to get the unlevered after tax cash flow. It's going to be the NOI minus the tax liability, and then you're going to add the unlevered sales proceeds after tax, which is $6.3 million. Altogether, you would walk away with the $6.6 million unlevered after tax cash flow. So that is how you create this table here. This is going to be critical for you to get your return summary. Now to go and create the return summary table, you should have all of these already typed in. We're going to start with the levered before tax NPV. Levered before tax NPV. It's asking us, Excel's giving us the hint here, equal to NPV, the discount rate, which I believe is 12%, 12%, the discount rate. And we're going to put the value for years 1 through 5, and then we're going to add back the year 0. So here it is. It is, we did the rate of 12%. We added years 1 through 5, and then we in our parentheses, and then we added outside of our parentheses, we added the year 0. So let me make sure I show that again. This is really important. So what we're doing here is we're saying equal NPV, the rate, which is 12%, comma, we're going to go down to the levered before tax cash flow, all the years, close paren, and we're going to add the year 0, which should give us the $406,000. That was the levered before tax NPV. To do the unlevered, it's the same formula. We're just going to use the same formula, equal NPV, the rate, which is the 12%, reference the rate. The row here is going to be the unlevered before tax cash flow row from year 1 through year 5. Close the parentheses and then add the year 0, which is the initial investment. If you did that, you should have negative $345,000. For the levered after tax NPV, you will use the same exact formula, equal NPV, reference the rate, the discount rate, after tax discount rate up here. And we're going to utilize years 1 through 5, close the paren, and then you're going to add back the year 0. And then you're going to do the same thing for unlevered, which you're going to do something for unlevered, which is going to be equal NPV, the after tax rate, which is reference for me, it's cell F6, and we're going to utilize the entire row here from year 1 through year 5, close the parentheses, and add back the initial investment. So you should have these 4 items calculated. Now we're going to calculate the before tax IRR. Before tax IRR is quite simple. It's much easier than NPV. It's equal IRR, and then you're going to go scroll up to the before tax row. It's the levered before tax IRR. You're going to use the entire row here from year 0 through year 5. This starts in year 0 for IRR. And close the paren, you're going to have 15.78%. For unlevered, same exact formula, equal IRR, and we're going to use the unlevered before tax cash flow row from year 0 through year 5. You should have 10.39%. For after tax IRR, we're going to use the same again formula, equal IRR. We're going to do the after tax, which is again levered after tax cash flow, year 0 through year 5, and close the paren, and you should have 11.96%. For unlevered after tax IRR, you should have, we're going to reference year 0 through year 5, equal IRR, year 0 through year 5, and you should have 7.49%. For cash on cash, last one we're going to calculate is going to be basically the C51, which is the before tax cash flow. This is how much money we're making before tax. We're going to divide that by our initial investment, which our initial investment was 2.5 million. That should give us, so we're getting on our cash, our only 5% on our cash on cash with the investment that we made for unlevered, and for levered rather. For unlevered cash on cash, it's going to be the NOI. The NOI, this because we don't have a loan, divided by our initial investment of 5.5 million. That should give us 6.35% unlevered cash on cash. Now, there's one more thing to look at. One thing we didn't talk about, last but not least, is if you look at the very top, we were told to calculate the after-tax discount rate. The after-tax discount rate formula is here, equal to your discount rate minus the effective tax rate, minus open paren effective tax rate times again the discount rate. That should give you the after tax discount rate. This is what you're going to be using to calculate your after tax and IRR. You're going to use that to calculate the after tax and NPV. I'm sorry, the after tax NPV. That's the only thing that I forgot to mention. You're going to be using this, not your discount rate, to calculate your after tax NPV. Thank you. I hope this was helpful. A very, very lengthy formula. I will provide another video which will show you how to calculate to do a what if analysis if you're looking for a particular levered before tax IRR. Thank you.